Share Shootout brought to you by Lion of Africa Insurance, insuring South Africa's future.
This is Share Shootout League on CNBC Africa, first in business worldwide. The Share Shootout League, of course, the most aggressive, the most cunning and the most vicious stock-picking show on television. So, will Barclays Africa Group results tomorrow be a reflection of how late they got into the African game? And why, oh why, is the Gauteng legislature fighting over dress codes when they're losing the battle on every other code? And will SAFA bring an end to the suffering? Now, we don't know the answers to any of these questions. What we do know is that Gary Boyson is the king of the heap. You look at Running Dog, you can see that from the results of last week's match between Sid, that's the Maverick, and Matthew, who goes by the name of Chi-Town, the wily old fox proved too slick for the Chicago City Slicker. This move sees Sid in the 6-point league, just 3 away from the log leader, Running Dog, which is why they call him Running Dog. Now remember, by using the power of the hashtag, you decide who wins this match and ultimately the Share Shootout League. Just follow at SSO League and tweet any of the stock pickers hashtags and we will count them. So back to the match at hand. Our first stock picker knows the real reason between the Ukraine standoff. Our second stock picker is a value investor who's losing all his valuables to his 1-year-old. Let's check out the plays.
Stand by for action.
My name is Alexander Naryshkine, but Sasha is short for Alexander. Call me Sasha, please. Everything from answering the phones.
Goldfield? Yes, I've heard of that company.
To attending to client email. To, make payments, everything. We like to answer our own phones because when someone phones, strangely, they want to speak to us. Ignore lots of the noise in the short term. Buy the quality and stick with it for as long as possible. Get inside Bruce's head just to try and confuse him as much as possible. Yeah, and act like Carl Icahn. Outrageous. Like, this board is pathetic. I've never seen such a useless board, when of course it's someone else's pick. Yeah, that's how I think I'm gonna win. Yeah, but you mustn't tell my competitors. Warren Buffett. No, I'm kidding. Has to be Bruce Whitfield. He's way too clever for everybody on this show, so if I can beat him, I'll be happy. I just need to beat Bruce, then I think I'll win this league, yeah.
Nic Norman-Smith, Chief Investment Officer of Lentus Asset Management. We follow a value investing approach here at Lentus. We generally are quite contrarian, so looking for areas of the market that people are really hate and are nervous of, and that's where we believe we can find the opportunities. I think it's about finding some stocks that the audience really like, exciting, and try and spice things up a bit and not just have the boring old favourites. I think Bruce Whitfield is definitely going to be the biggest troublemaker on the show. Yeah, absolutely, one must be positive. I think it's going to be a tough competition, so for sure.
Well, both Sasha Naryshkine from Vestact and Nic Norman-Smith from Lentus Asset Management are on 6 points on the log. But before we get to the game first, let's get the house rules out of the way. Both have pre-picked 3 shares. Each has got to accept at least one of their competitor stocks, and they've each got 30 seconds to argue their stock pick. Stock pickers can choose from the JSE, but they've also got an offshore allowance which they can utilize. Got the house rules out of the way, gentlemen. Let's do battle. I think Nic Norman-Smith can go first for wearing FNB colours this evening. You're looking partisan.
Just calming blue, Bruce.
How can he help you?
I'm not being soothed one little bit. So let us go to your first pick. You're going to the banking sector. You're going to the standard side of the market, but you're using your offshore allowance. This is interesting because in 30 seconds, Standard Chartered. Why?
This is London listed, but it's a global bank. It's an emerging market focused bank, but it's pretty diversified across the world. This was a very popular bank over the last 10 years, traded 15 to 20 times earnings, growing, exciting exposure across the world. Then it hit a bit of a hiccup, and there was big pressure on its emerging markets exposure. Now suddenly people don't like emerging markets too much anymore. Valuation is very attractive now, so it's gone from 2.5 times book to 1 times book and 12 times earnings. Nothing fundamentally bad about this business except it's out of favour now.
There we go. It's the bank that nearly but didn't buy Nedbank. You don't like banks generally, Sasha. I mean, you don't mind going there. They provide you cash. That's nice. The ATM is about where your love affair with the bank stops. Standard Chartered, can you like it?
We got a perpetual joke in the office. It's a finer week for the big banks. You say, whose turn is it this week, to be fined by the SEC? No, that's a joke, Nick. But I think I'd take Nick's point here. Nick's point is that if you're looking for something that's cheap globally inside of the banking sector, and as he mentioned, emerging market exposure, anything with that sort of brush has been beaten up. So I think I'm going to agree with him just on a value play here.
Okay, but
It's 40% down off its highs.
it may be, but I mean, so was Enron before it collapsed. Not that Standard
come on.
Chartered.
This is a real business.
This is a real business
company.
with fundamental.
This company's been operating in emerging markets for the last 30, 40 years.
It is out of favor. And it is out of favor because emerging markets are out of favor.
Bruce
You need
doesn't like
emerging
banks
markets to
either.
bounce back for the share to come back in favor. Is this a forecast of an emerging markets resurgence, or is it simply the existing business of Standard Chartered is undervalued relative to what is really going on?
Exactly. It doesn't have to bounce back. That's the thing. You're buying the assets at book value. Now, banks traditionally earn 10 to 15% returns on equity. So even if it just stumbles along, doesn't do too much, doesn't completely blow up, buying these banks at book value, we chatted about this a year ago, 2 years ago, buying Wells Fargo when America was out of favor. You bought that at book. It's now trading at 2 times book. It will bounce back. It's a high quality bank. It will revert back to historical pricing measures.
You're buying it, Sasha. You're taking it.
Yeah, I don't know what his other two are, but I buy his value argument, and I know he's the value guy.
There we go. So you're buying it. You have been accepted on your pick this evening, your first pick this evening, Nic Norman-Smith, of Standard Chartered. Market cap of $30 billion, dividend yield of nearly 5%. You didn't use that little ace up your sleeve.
There's just so much good. I didn't have time.
Sasha Naryshkine, you're going next. I'm interested in your first pick. It's one of your long-term favorites. It's a company worth 400 odd billion rand. It's Sasol in 30 seconds. Tell me something new.
Okay, well, I think everyone kind of views the commodities game as the same. The best thing about oil and gas is when you use it, it's gone. You can't recycle it. David Constable, strong in North America. That's where their presence is going to be. Louisiana is key to the revaluation of this business. This is a growth business, They grow Synfuels volumes at a higher rate than SAB grows beer volumes, but yet SAB trades on a 28 multiple and poor Sasol gets like a 10 forward. If they were to re-rate to their high PE of around 13.5,
you'd be a very happy guy.
And so would you.
I mean, you're a value guy. This is a cheap share. You've got to take it.
It is. I mean, we've held it for a number of years. I don't think it's as cheap, incidentally. I like it. I don't think it's as cheap for 2 reasons. One, I think the oil price is a little bit rich if you look at fundamental basis, and we've all been lulled into this false sense of security because the oil price has been phenomenally stable for the last few years. But still, maybe 10, 15, 20%, nothing major. On a 10p, it's still cheap. There is the reinvestment risk of these projects, which will take longer and cost more than one expects. So those are the only risks. Other than that, it looks super cheap. But again, there are a few risks, but hey, if that business grows, it could be phenomenal. And again, if you're paying only 10 times earnings for the stock, you've taken a lot of the risk out of the equation. So it's certainly one that I like.
So you're going to take it. We've spoken about Sasol so many times on the show. Let's rather dedicate a bit more time to some of your more
Can I put in
adventurous picks.
one 5
Last
sec-
one, if you
Come
must.
on. I think a revaluation can come simply with having a North American presence. And I know it sounds silly, but investors in North America will say, hold on a second, they've got real businesses that we can see, because only 10% of Americans have got passports.
Yes, there we go.
Look, the whole global oil sector looks reasonably cheap anyway. So that's part of it. But no, it's attractive stock.
He's taking it, okay?
Yeah.
Quit while you're ahead.
Okay.
Don't give him time to change his mind.
Okay.
Okay, we're going, and you're staying with the banking sector, and this is what's really interesting, because we know Sasha doesn't like banks, which is why it's going to be incredibly hard for him to shoot down your short on Capitec. In 30 seconds, tell me why, Nick.
No, I'm not going to go to Stellenbosch for the next while, but wonderful business, one of the greatest success stories we've seen in South African business in a number of years. Microlender, 30 billion rand book, but quite frankly, it's trading at 3 times book. Oh, look where Standard Chartered was before it dropped 40%. Yeah. PE doesn't look too bad, it's 12 or 13 times, but that's on cyclical high earnings. But it's exposed to a sector that is under pressure. Now, I'm sorry, I don't care how super smart you are, and the Capitec people are smart, that you can completely avoid a sector that has taken Able, JD Group, credit retailers and everyone down. It's just not possible.
There we go. And so you're shorting Capitec. You've got to accept that one too, Sasha, because you're not a big fan of South African banks. You certainly cannot be a big fan of microlenders based on the philosophy, investment philosophy that you espoused. You've got to accept it.
Yeah, I think he'll accept one of my next 2. So
you'll take 2 of his?
I'll take 2 of his. I think he'll accept one of my next 2. I know which one he won't accept,
yes,
but I know which one he probably will accept. So I think, for a long time, people compared Able and Capitec and wondered why their systems were so much more incredible. I think because they came in a newer era where their technological advances were so much better in terms of their credit scoring than any of their peers.
But they've still made mistakes, and they've still had high levels of write-offs, and those levels of write-offs have been rising. As Nick makes the point, you can be the smartest guy in the room, but when the cycle, when the sector, when the industry, when the economic fundamentals of a country turn against you, it's incredibly hard to maintain your earnings.
Just look at the numbers. So it's 3 times book value, right? Banks, they're earning 20% return on equity, which is very high for a bank, highly unlikely to be sustainable. As I said, 15 is probably more reasonable. On 15 times return on equity, you're earning 5% because you're paying 3 times the value for those assets. So unless these guys are going to be different to all the banks that have ever operated in the world.
There's only one reason why you might not short this share, Sasha, and that is because it's got a small free float and the shares are tightly held. PSG is a big shareholder. They've got big management shareholdings within this business as well. Shorting a stock like that is very high risk. You can avoid it by all means, but shorting it is perhaps too aggressive.
Yeah, I remember saying that once to someone, and they said, but it actually works the other way too. You know, because those shorts are committed long-term shareholders. Why would they be fighting against a small liquidity pot themselves?
And if a few people do try and get out, you know, then, yeah.
Exactly. It has the opposite effect.
Now, I don't know if I buy the shorting Capitec, or I can short many other things, but just because it is so tightly held, I wonder if it's not being too aggressive.
Where he's not going for holiday.
But he's never going back to Stellenbosch ever again, because in Stellenbosch got very long memories.
Yes.
And you're accepting the short.
I am.
You ain't going back to Stellenbosch anytime soon either.
Well, I've probably been there about 3 or 4 times in my life. So.
Okay, but don't ever go back, because they're going to take you both down.
They're going to take my degree away, I think.
Forever.
The fact that they gave you one is a miracle.
Fair point.
Okay, so short on Capitec, you're accepting the short, which is interesting because you've accepted 2 of Nic Norman-Smith's picks this evening.
Yes.
It's the new nice Sasha. People aren't scared of him anymore. He's like the rubber-toothed lion. Okay, Sasha Naryshkine, let's go to your second pick, which on a valuation basis, Nick's going to find hard to shoot down.
Yes, and that's why I went for his.
Because you have no relatives in the furniture business, although this guy's recently bought the uncle, hasn't it? Steinhoff, in 30 seconds, tell me why you like it.
Well, I think, you know, the reason why the share price went up so much was because their European recovery story came into play. Now, remember that in Europe, through their Conforama business, they're up against IKEA, but they're 1/9 of the revenue of IKEA. It's no longer a South African business, so there's a rand hedge element. I think what they're going to do with JD is somehow find a way to get rid of the book. There are no borrowings at Conforama, so they're going to institute a similar methodology here.
Okay. I'm looking forward to seeing how it happens. Nic Norman-Smith, it's a hard one to shoot down.
Especially since I think I picked it last round.
Because I'm going back into the mists of time, and I think you do like it.
Yeah, I do. We've liked it for a long time, so it's been a very happy place for us. And what's interesting, I was having this discussion with someone. I mean, it's up 100% or so in the last year. And you look at it and you think, well, gee, I've got to be looking to be selling this, surely. And then you look at the underlying valuation and how much they've grown the business and improved the business, and it's still not particularly expensive. So we're still holding it. We're not adding to our positions because it's grown into such a large portion of portfolios. But it's still not ridiculously expensive, especially in a market that is generally quite rich.
And if you're a South African investor and you want to get some rand hedge exposure, you've got to buy SAB Miller, multiple of 20-something times, Richemont of 30-something times. You really do struggle to get a rand hedge exposure at 10 or 12 times earnings.
And I think with all the extra shares in issue, probably looking at somewhere around R4.70 to R4.80 for the full year. So even at the rights issue at 52 Rand, you'd be, I think, you'd be silly not to follow your rights at that level.
Yeah, so interestingly, we haven't again just because we want to dilute our shareholding. So instead of selling, we're just not following the rights. And I think a lot of the large institutions have done the same. But smart time to be raising equity. The share is not it's not ridiculously expensive. It's not super
But it's
cheap.
elevated 12 months ago.
Well, they're diluting you by half of what they would have if they'd raised equity back then. And they're sitting on 20 billion, which is twice the market cap of African Bank. So, who knows? They've got a lot of firepower. So I think that's smart. And we've seen that with all of these smart companies, your Capitecs, your PSGs, raising equity when the share price is elevated, as opposed to the resource companies and various others that are raise equity at the bottom and dilute their shareholders.
Where has Steinhoff been based? Oh yes, in Stellenbosch.
So we can go back.
You can go back now. You can
I
go
can
back
go to
again.
Marcus Juster's house, but yeah, that's about that.
But he's a financial engineer extraordinaire. That's my passing shot.
But he's aggressive,
Yeah.
but and he's a big risk taker. He owns racehorses, and he clearly is a big risk taker. But he takes smart risks. He bought Conforama when no one wanted to touch Europe, so that's the kind of thing. And who knows what he'll do locally, but I'm sure he's going to be spending that money in areas where no one else wants to go, and that's when you get good prices and good returns.
It's fabulous. So what we've got is the most collegial share shootout in the history of share shootout. Both of our pickers this evening have picked the other pickers 2 shares so far. So what we've got from Sasha Naryshkine is Sasol and Steinhoff, and Nic Norman-Smith has very kindly said, you know what, I'll take both of those, thank you very much. And Nic Norman-Smith's going long on Standard Chartered, Sasha accepting that based on the valuation of it being 1 times book value. And Capitec, Nic Norman-Smith is going short. Sasha supports the short, but I think they may both lose their shirts on that short. It's never too early to take to Twitter. Follow at SSO League and cast your vote for either Bucks, that's Sasha, or hashtag Value Guy, that is Nic Norman-Smith. Use the power of the hashtag, and we will see you after this. You're watching Share Shootout League right here on CNBC Africa, the only league without a transfer window. Now remember, this is match day number 14, and through your Twitter votes, one of our 2 stock pickers can change the look of the league. All you have to do, follow at SSO League on Twitter, and you vote for either hashtag Bucks or hashtag Value Guy. What they've done so far this evening has been terribly cooperative and terribly nice to each other. We're hoping that changes. Sasha Naryshkine from Vestact getting the thumbs up for both the Sasol and Steinhoff picks, and Nic Norman-Smith from Lentus Asset Management getting a thumbs up for a long on Standard Chartered and a short on Capitec. Nic Norman-Smith went first last time, so Sasha Naryshkine, you have the honor of going first this time. Search me. Search me, search me, search me in 30 seconds. Did you find this pick on Google?
I did. I found it on Google Finance, where you can look at GOOG or GOOGL. So why buy Google? Because it's not as expensive as Nick might think. You know, it trades on 21 times next year's earnings. For a business growing at roughly earnings 30% per annum, I think that you'd be silly not to pay 21 times. Plus, 90% of their business comes from advertising, but they got 40 separate businesses. I think this is the GE of the 21st century, and they've got smart people that run this business.
And search me, that's all you've got time for. If you went onto Bing and I said, should I buy Google shares, what would Bing say to you?
Well, Bing's advertising revenue was actually up 40% in the last quarter. So
But is that indicative of what's going on at Google?
Yeah, it's when you've got like 1% of the market, you can double quite easily. Wonderful business. A couple of concerns. One, 21 times earnings, I'm sorry, is expensive.
But you paid 21 times earnings for a pretty solid 30% earnings stream.
Well, if you think that it's going to continue growing, that's what
And
people
why
did
should
with
it not?
That's what people did with Standard Chartered a few years ago, and that's why it was trading at 21 times earnings, and that's why it's down 40%. So that's the risk when you're doing this.
Standard Chartered are not going to change the world, Nick.
The concern, a couple of things. One, reinvestment risk, because they're a one-trick pony. It's a fantastic trick. Search, they've revolutionized it. I think it's the one real internet advertising business that I do like. I think Facebook and all these others, they're going to come and go. There's nothing special, but the way they've integrated search with paid for advertising and auctions is great.
Okay,
but they're reinvesting it into a whole lot of crazy things, and that's worrying. Second, the ownership structure.
They've got too much money and it's burning a hole in their pocket.
And the ownership structure is against normal shareholders, because the founders and the first people have got different. I don't like these funny share classes that give other people control in case they do something wrong and someone wants to come in. So
Respond, Sasha.
Yeah, that's it's not as outrageous in North America as it is here in South Africa, where people get worried about the different share classes. In America, sometimes a lot of people say, well, that's great, we want the founders, and they've got a lock-in until 2024.
By which time they'll be 30, and they can
Well,
be pushed out
I think
faster.
Eric Schmidt will be a bit older.
Possibly, yes.
But he still looks young, even though I think he's, 56, 57. So
a couple of billion in the bank will do that to you.
Yeah, exactly. So I don't know. I don't share Nick's concerns, because fiber, they've installed a massive fiber network, and we all know everyone wants faster and faster internet speeds. I remember Michael Bloomberg on an interview in one show with, I think might have been Charlie Rose, said, our biggest worry today is being able to download something in 17 seconds instead of 30, you know. So I think their different businesses will start contributing in due course. They're always buying little businesses and adding them on and on and on. So I don't, and I think 16% of their market cap is cash.
I think you can talk until you're blue in the face. He's not going to accept it.
No, he's not.
He's not going to accept it.
Yeah.
And the simple reason is, I mean, the one-trick pony allegation, I thought that was very vicious.
Well, for the time being, he's right. He's right. But they've got all these other businesses.
What makes a group of very smart techies who built this suddenly turn into this amazing venture capital company? Maybe it'll happen, but I'm not convinced. And again, unlike a Sasol at 10 times earnings, you're paying 21 times earnings. If something goes wrong, you're under the pressure. And in the tech sector, you can get a lot of other tech companies with 25, 30% of their market cap in cash, 10, 11, 12 times earnings.
You're shooting it down. Okay, then tell me why Sasha should accept your final pick. Taking a bit of a gamble as we close up the show this evening. SAB Miller has sold out at Tsogo Sun. You're seeing this as a prime opportunity to buy into Tsogo Sun. In 30 seconds, tell me why.
Don't need to sell you on gambling. It's highly addictive. It's been around since day dot, and people are unlikely to stop being greedy. They have some of the greatest casino assets in the country. Urban casinos. So Monte Casino, they're buying a stake in Grand West and the Cape, casinos in Durban. Urban casinos are great because they're very high margin. You don't have to build a whole Sun City to get people there. You just pop up a casino and all the people from the city come in. Plus they've got a hotel portfolio which is a lesser degree contributing. And that's at a relatively low point of the cycle. That has big operational gearing.
Absolutely. But hotels are expensive to run, they're complicated to run, and people complain about the room service. What they don't complain about, however, is the adrenaline that comes from gambling. You can't be a fan of gambling. You don't like British American tobacco as a house. You can't like gambling because it's people doing harm to themselves, Sasha.
I think I've been 3 times, and that was after I was married, and my wife said, come, let's go. And I think I blew about $200. And the last time I went 10 years ago.
Straight to the bottom line.
Yeah, so that's why I've never gone back, because it was Voltaire who said, gambling is stupidity tax. The only thing that I can say...
Fortunately, not everybody is as bright and as capable as you, Sasha.
And Nick, yeah.
I can't tell you when last I went either, but yes.
Look, I think regulatory problems that they're going to run into somewhere down the line. You know, when it starts, government budgets start getting tighter and tighter, they're going to say, look, who's the soft target here? It's beer, it's cigarettes,
they have tried to tax casinos, they've tried to tax casino winnings. It's an impossibility.
No, I'm not talking specifically about the winnings, because, as you know, the house always wins.
Yeah.
I'm more worried about regulations being placed on people with the licenses and having to become...
That's exactly why, incidentally, we like it.
Because the regulators will keep everyone else out.
There are 42 casino licenses in the country. They're unlikely to be any more issued. So unlike so many other industries, if you're making lots of money, you can't get a whole lot of competitors coming in. You are regulated, you're regulating your competitors out. It's why tobacco is so great.
I was chatting to myself on Orlok, the chief executive of Tsogo Sun, on this channel the other day.
He's younger than all of us.
And incredibly indebted.
86 million.
I think he's got about 86 of the 200 million rand loan that's been given for free shares. He believes, to buy shares, he believes that this is a sure thing. That's why he's taken such a big loan out to buy the shares in the company. They're also not looking for new licenses. They're simply expanding the footprint. So expanding the gambling halls at Grand West, expanding the gambling halls because there is demand. It's the stupidity tax you talk about, but in a place, especially like Gauteng, where entertainment is fairly limited, people will line up to throw their money away.
And I know it's a sensitive topic that the senior management got all of these shares and everyone else didn't. But quite frankly, I'd really like to be invested in a business where someone else, yes, it's interest-free, but he's still got to repay 86 million rand if that share price goes down.
Isn't that why you didn't like Google? Because the shares are too concentrated amongst the founders?
No, because they have a vote that's different to everyone else. In Tsogo Sun,
but they will now have a vote with HCI, because that's why HCI did it.
And HCI are super smart, and I'm so excited that HCI are getting involved in this. They've already arranged for them to buy back shares at a significant discount, so steering them in the right direction.
Nic Norman-Smith is a big fan of Tsogo Sun. You, Sasha Naryshkine, are not a fan of gambling.
Gambling.
But are you a fan of the company?
No, because
shoot it down.
Well, more than 80% of their revenues are from Shootout. Okay.
It's shot down. Okay, so what happens at this point of the show? You have to vote, and we'll be counting your votes until midnight on Sunday. These guys need your vote, so what you do is you follow at SSO League on Twitter, and you vote for whichever one of these guys you like, whichever one you pity most. Join us again right here on CNBC Africa next Tuesday, 8:30 for Match Day 15 on the most merciless stock picking show on TV. Check out at SSO League. Give us your thoughts on the players, the league, and you can also make fun of their hairstyles and their stock picks. Okay, so he's got a hairstyle. Sasha doesn't have a hairstyle, but make fun of whatever you like. Until next week, stay cunning. Good night.